Ever wondered how some investors consistently seem to unearth those hidden gems in the stock market?
Yeah, those ones that just seem overlooked.
Exactly. Or why some incredibly valuable companies inexplicably trade for significantly less than their true worth. Today, we're not just scratching the surface, we're taking a truly deep dive into the fascinating and often counterintuitive world of finding undervalued stocks.
That's right. Our mission today is really to equip you, our listener, with foundational principles, the practical tools, and maybe most importantly, the crucial mindset shifts you need to identify these overlooked investment opportunities.
Okay.
We'll try and cut through the market noise and the often irrational emotional swings by exploring insights from legendary investors and real-world examples drawn directly from the rich materials you've shared with us. This isn't about fleeting trends. It's about enduring wisdom.
Think of this as your shortcut to becoming truly well-informed, armed with surprising facts, and hopefully just enough humor to keep you hooked on the path to becoming a more self-reliant and informed investor. Okay, let's stop dilly-dallying and truly unpack this, starting with the very heart of the philosophy. Why was value investing the core philosophy?
Right. So at its simplest, I guess, deep value investing is about buying assets, could be a whole business, could be shares at a significant, almost audacious discount to their real worth.
A deep discount, yeah.
It's not just about a company looking cheap on the surface,
Right.
'Cause that can often be misleading.
Totally. A mirage, sometimes.
Instead, it's about a company genuinely selling for substantially less than its inherent underlying intrinsic value. It means getting to the absolute heart of what the business itself is truly worth, regardless of, the daily drama of its stock price.
We're looking past the noise.
Yeah, exactly. You're looking beyond the fleeting ups and downs and trying to find that steady hum of the true economic engine underneath. And that discount you're talking about, that gap between the market price and what it's really worth, that's what Benjamin Graham called the margin of safety.
Ah, Graham, the father of value investing.
The very same, often called that, yeah. He established this incredibly vital concept, arguing that the bigger this gap, the safer your investment actually is. It's your main protection, really, a buffer against maybe misjudging things yourself.
What happens?
Oh, absolutely.
Yeah.
We're all human. And it also guards against those unforeseen market events, the black swans that can pop up.
Right.
And crucially, this margin of safety, this cushion, it also directly links to the potential for getting those outsized long-term returns. We've seen recommendations from different gurus, anywhere from maybe 10% up to a really conservative 50% discount.
Wow, 50% is huge.
It is, but it's, in essence, a direct measure of how safe that investment is meant to be.
And understanding this margin of safety, it's not just theory, is it? It's absolutely key to protecting your capital. Because, as we know, losing money is mathematically just so much worse than simply not making money.
It's brutal math, isn't it?
Yeah, think about it. If you take a 50% hit on something,
Ouch.
you don't just need 50% back to get even, you need 100% gain just to break even.
That really puts it in perspective.
It does. It shows why protecting against permanent capital loss is just paramount for anyone looking for long-term success. It's not just offense, it's mostly about playing really solid defense first.
And where did this all come from? Well, the roots of value investing go way back, actually, to the 1920s. It was properly formalized by these two brilliant guys at Columbia Business School, Benjamin Graham and his colleague David Dodd.
Graham and Dodd, still legendary names.
Absolutely. Their book from 1934, Security Analysis, it's not just some old textbook. Many still call it the value investor's Bible. It laid out the whole framework for fundamental analysis that's still incredibly relevant today.
Amazing how it's lasted.
It is. It wasn't just some passing fad. It was built on solid academic thinking and, what actually worked in the real world.
And from those teachings came probably the most famous student ever, right? Warren Buffett.
The Oracle himself.
Yeah.
Yeah, he didn't just learn it. He took Graham's principles and massively expanded on them, building Berkshire Hathaway into what it is today, one of history's greats, no question.
But he's not the only one who followed this path.
Oh, definitely not. You've got others like Charlie Munger, Buffett's right-hand man, Seth Klarman, who wrote that other classic, Margin of Safety, Walter Schloss.
Schloss, the quiet compounder.
Exactly. Joel Greenblatt, Jerome Boss, Monish Pabray.
Yeah.
All built amazing careers on this same foundation. It just shows how versatile and powerful it is across different markets, different times.
And it's not just anecdotes about famous people, is it? There's actual data backing this up.
Critically, yes. Loads of studies, academic work, they've consistently shown that value stocks over the long haul, tend to outperform other strategies like, the flashier growth stocks.
Right.
For instance, research from Bank of America, looking way back to 1926, found value investing returned something like 1,344,600%,
Whoa.
compared to 626,600% for growth. I mean, that difference is just staggering.
It really is.
So the evidence over almost a century is pretty clear. Buying stocks that maybe look a bit ugly or boring or disappointing.
They're unloved ones.
Exactly, the cheap ones.
Mm-hmm.
Historically, that's been the best way to put the odds in your favor, letting that reversion to the mean work for you.
Okay, here's where it gets really interesting for me, and I think this is the big mental shift. Graham taught Buffett this unique way to look at stock quotes, right?
A radical way almost.
Instead of just accepting the market's price as the final word, Graham said, you have to ask, how much is the entire business selling for?
That flips everything, doesn't it?
Completely. It changes your perspective from just watching a ticker symbol bounce around to thinking like an owner of a real productive business. It's a fundamental mindset change.
Yeah, let's make that concrete. Imagine someone offers you a 5% stake in, say, a local coffee shop for $10,000.
Yeah. Okay.
Your first thought wouldn't be, what's the daily price of that 5%? No. You'd instinctively multiply that $10,000 by 20 to figure out the implied price to the whole shop, $200,000 in this case.
Right, the total valuation.
Exactly. Then you'd ask the real question. Is the coffee shop itself a good buy at $200,000? See how that shifts your focus away from the fickle stock price?
Yeah, it's about the underlying business, the earnings, the cash flow you'd get as an owner over time.
Precisely. It's about what the business can actually return to you, not just what the stock price does tomorrow or next week.
And Buffett himself hammers this home all the time. He says you should never judge a CEO based on the stock's yearly performance.
Right, because in the short term, it could be totally disconnected.
Over the long run, sure, a stock should track the business performance, but short term, there might be zero correlation. Market whims, news, herd behavior, it messes with the price.
It's all about what the business earns for you, the owner, over the long haul, not the daily noise.
So this naturally leads to a buy and hold approach, doesn't it?
Absolutely.
Yeah.
It inherently stresses that strategy. Often, we're talking about holding shares not just for years, but maybe 20 years or more.
Wow.
This long-term view deliberately avoids all the traps of trying to time the market short-term, reacting to every little wobble.
Yeah.
You recognize most of that is just noise, meaningless chatter distracting you from the real signal.
It takes serious discipline, though.
Immense discipline to let those carefully chosen undervalued investments just sit there and compound, potentially for decades.
And Jerome Bossy, you mentioned him earlier, he said something I liked. Deep value investing is not conducive to buying no matter the investing climate, nor is it about being a busy investor.
Love that quote, too. It nails it. It takes a ton of time and careful work just to find the right company that meets your strict criteria.
And then you wait.
And then you wait even longer, often years, for the market to finally wake up and see the value you saw. The whole system, the financial industry, kind of pushes you to trade to be...
Transaction fees, yeah.
Exactly. But real value investing demands the opposite. Patience, selective action, and the guts to just do nothing most of the time.
And the data really backs this up, doesn't it? Trying to time the market.
It's largely a fool's errand. Research shows it consistently. Most people, unfortunately, end up doing the exact opposite of what they should. Buying high when everyone's excited, selling low when panic sets in.
The classic mistake.
It is. One study found that just to match a simple buy and hold return, a market timer would need to be right an incredible 82% of the time on their calls.
That's almost impossible.
Pretty much, just to get what you could have gotten by basically doing nothing after your initial purchase. The risks of timing are just way higher than the potential rewards. Long-term patience wins. 2. The toolkit. How to find undervalued opportunities.
Okay, so if the foundation is this mindset shift focus on the business, be patient. The next big question is, how do we actually find these opportunities? What's in the toolkit?
Right. This is where fundamental analysis comes in. It's not guesswork. It's like being a financial detective digging into the company's health.
Okay, where do we start digging?
You absolutely have to start by decoding the financial statements. They're the language of business, really. Standardized ways to see what's going on.
Makes sense. Let's start with the income statement. That's like the report card, right? Shows revenues, costs, profit over a period.
Exactly. Quarterly or annually, usually. Shows revenues, expenses, and that bottom line, net profit or loss. Most people fixate on that net income number.
But there's a catch.
Big catch. Be careful, that net income figure. It can sometimes be, let's say, managed or heavily influenced by one-off things, like selling a big asset or taking a big restructuring charge.
So it doesn't reflect the core ongoing business health necessarily.
Not always, no. You need to look deeper than just that one number, understand how they got there.
Okay, then the balance sheet. That's different. It's a snapshot in time.
Precisely. It shows what the company owns, assets, what it owes, liabilities, and its net worth equity at one specific moment. It tells you about its financial position, its solidity.
Or fragility.
Or fragility indeed. And interestingly, Jerome Boss, we mentioned him, he actually likes to start his analysis with the balance sheet before the income statement.
Why is that?
He argues earnings can be easily manipulated, they're more volatile, less reliable for true worth. The balance sheet, he feels, is more grounded, gives a more solid starting point, less subjective.
Interesting take. Okay, and the third one, the cash flow statement. You said this is critical.
Absolutely critical, in my view. This shows the actual cash moving in and out. It details cash from operations, from investing activities like buying equipment, and from financing like debt or issuing stock.
And the key is it's harder to fudge the cash.
Much harder. It's less prone to accounting games than net income. It gives a truer picture of the company's liquidity, its ability to pay its bills, its real underlying health. Cash is king, as they say.
Got it. So statements first, then we use ratios to make sense of them quickly.
Exactly. Ratios help us compare and assess valuation and health. First up, the classic. Price to earnings, or PE ratio.
Share price divided by earnings per share. Everyone knows this one.
Right. And while a lower PE can signal undervaluation, what counts as low really depends.
On the market, the industry.
Exactly. Maybe below 15 is low in some markets, but in others, maybe below 10 or even below 20 could be low depending on growth. You have to look at the context compared to competitors. And by the way, a PE ratio that's shooting up, that can be a sell signal. Might mean it's getting overvalued.
So it's not just the number, it's the investigation behind the number. Is it cheap for a reason?
Precisely. Is it a temporary blip or a sign of real trouble? That's the work.
Okay, next ratio. Price to book, PB share price divided by book value per share.
Right. Reflects the value relative to the company's assets minus liabilities on the books.
Yeah.
Walter Schloss, that quiet compounder we mentioned, he explicitly loved buying stocks below book value. He felt it gave him a certain amount of protection. You're buying assets for less than they're recorded at, essentially.
Buffett liked book value too, didn't he? Partly because earnings can be massaged.
Yeah, pliable was his word. Earnings can be legally managed with accounting choices. Book value, while not perfect, tends to be a bit more stable, harder to fudge. Though for asset-light businesses like software, PB isn't very useful. You adapt.
Good point. Okay, what about debt? Debt to equity ratio, DE.
Crucial measure of leverage. Compares total debt to shareholder equity. Higher leverage generally means higher risk, more obligations, especially if times get tough.
And Schloss liked low debt companies.
He favored no debt, actually,
Right.
to avoid the worry of paying it off. Makes the investment more resilient, especially if the company hits a rough patch. More flexibility.
Makes sense. Then there are returns, return on equity, ROE, and return on invested capital, ROIC. How well are they using the money?
Exactly. ROE looks at profit generated from shareholder equity. ROIC is often seen as better because it looks at returns on all capital debt and equity combined. Generally, high returns with little debt. That's the sweet spot. Strong profits without too much financial risk.
And there was that research about ROIC. Some companies just keep high returns.
Yeah, Michael Mobusin's work. Most companies' ROICs eventually revert to the average because of competition. But about 4% seem to defy that gravity.
The super performers.
Right. Usually companies with incredibly strong brands, durable products. They have a persistent edge, a moat, that keeps competition at bay for decades.
Fascinating. Okay. Beyond returns, you also mentioned sales growth. Why is that important separately?
You want to see the core business actually growing, not just generating returns by selling off assets or something. That can make the numbers look good temporarily, but it's often a bad sign for the long term. You want sustainable revenue growth from the main operations.
Got it. And finally, working capital and liquidity ratios, like the current ratio.
Yes, current ratio, current assets to current liabilities, and quick ratio, similar, but excludes inventory. They check if the company can meet its short-term bills. Schloss, again, really emphasized strong working capital, and watching inventory levels is key too. If inventory piles up faster than sales.
Trouble brewing, less demand.
Could be. Decreasing popularity, maybe obsolete stock. It's a subtle but potentially powerful warning sign.
Okay, so numbers are vital, but you said they only tell part of the story. We need qualitative analysis too.
Absolutely. Beyond the financials, you need to really understand the business model. What does the company actually do? What are its products, its services? What makes it unique?
Like your McDonald's example, it's not just burgers, it's a franchise and real estate powerhouse.
Exactly. Understanding that deeper business model is crucial.
Which leads to the moat idea, competitive advantage.
Probably the most important qualitative factor. What gives this company an edge? What protects it from competitors nibbling away at its profits?
Could be patents, scale, regulations.
High switching costs? Like trying to ditch Microsoft Office across a huge company. Network effects where more users make it better, like Visa or Facebook. Buffett loves businesses where there's an absence of change because stability protects profits. A strong moat lets you raise prices or fend off rivals. It's the castle wall.
And the people running the castle. Management quality and shareholder friendliness.
You have to ask, do I trust these people with my money? Assess their integrity, competence, and especially how they allocate capital.
Yeah.
Are they building value or lining their own pockets?
Red flags being misleading investors, crazy high pay, burning through cash.
All of the above. Serious value investors dig deep here. Randall Abramson meets management quarterly, asking the same questions, looking for consistency, passion. Candace Weir builds personal connections for insight. Edward Studzinski used his criminal defense background to spot when management might be less than truthful.
Wow. You're looking for honest, capable stewards of your investment.
That's the goal.
Okay, we've got the tools. Now, where do we go hunting? Where are the strategic spots to find these potential deals? You mentioned the bad news phenomenon.
Yes, the market often overreacts, right, emotionally. Bad news hits, earnings miss, lawsuit, recession fears, and prices can plummet way more than the fundamentals justify.
Creating opportunity for the rational investor.
Exactly. Buffett saw this in the '87 crash.
Yeah.
Panic everywhere. But he saw quality companies being given away, some below book value, even though the U.S. economy was still fundamentally okay. He saw bargains where others saw a disaster.
Like Christopher Brown said, buy stocks like groceries when they're on sale.
Perfect analogy. Fear drives prices down, creating those opportunities. Takes courage to buy then, but that's often where the best returns are made.
Another hunting ground. Spin-offs and reorganizations. What's the opportunity there?
So a spin-off is when a big company sets a division free as its own independent, publicly traded company.
Okay.
The opportunity arises because big institutions that own the parent company might be forced to sell the shares of the smaller, newly spun-off entity. Maybe it's too small for their mandate, wrong industry, whatever.
So it's not selling based on fundamentals, it's forced selling.
Precisely. That can artificially depress the price of what might be a perfectly good, newly focused business. The classic example is eBay spinning off PayPal.
Which worked out pretty well for PayPal shareholders.
Extremely well. Suddenly, PayPal was free to focus, innovate, grow, without being tied to eBay's structure. These can be gems.
Interesting. What about digging through filings like 13F?
Yeah, regulatory filings.
Yeah.
In the U.S., big investors, those managing over $100 million, have to file 13Fs quarterly, showing their U.S. stock holdings.
Where do you find those?
SEC.gov. They're public, due 45 days after quarter end. Useful for seeing what smart money is buying or holding. But remember, they only show long positions, not shorts, and they're backward-looking. And crucially—
You need to know which managers are actually good, not just famous.
Exactly. Fame doesn't equal skill. Do your homework on whose track record is worth following. Some stars are quiet, some famous names consistently lag.
Good point. What about company size? The small cap advantage.
Smaller companies often get less attention, less analyst coverage, and fly under the radar.
Meaning they could be mispriced more often, offer deeper discounts.
Potentially, yes. Buffett found lots of his early big wins in small Omaha companies before Berkshire got huge. But there's a flip side. Some investors, like Ralph Shive, prefer larger companies, arguing they have less downside risk if you're wrong, maybe more diversification within the business itself.
So it's a trade-off. Potential bigger upside in small caps, maybe more perceived safety in large caps.
It is. Depends on your style and risk tolerance.
Okay, beyond the financials and filings. Finding ideas in everyday life. Serendipity.
Absolutely. Keep your eyes open. Observing consumer businesses, retail especially. You might spot trends or problems before the market does.
Like that Tesco example. Seeing empty stores despite nice products.
Exactly. That was a real-world observation, boots on the ground, signaling trouble ahead. Your own job or background can also give you unique insights into industries others don't see or understand. Leverage what you know.
You also mentioned service companies, like recruitment firms, being good, deep value candidates.
Often, yes, because they're flexible. In tough times, their main assets are people and connections, not factories. They can cut costs quickly, making them quite resilient compared to asset-heavy businesses.
Makes sense. And these principles apply beyond stocks, like in real estate.
Definitely. Finding undervalued property involves looking for distressed sellers, people who have to sell, understanding market shifts, interest rates, doing rigorous analysis, underwriting, stripping out the emotion.
And local contacts are key there.
Hugely valuable. Property managers, lawyers, CPAs, they might know about off-market deals you'd never see otherwise. Gives you an edge. And right now, assuming existing loans, especially certain types of agency loans, is seen as potentially a very good idea, though complex. Often needs a group of investors.
So value principles are transferable. Okay, with thousands of stocks out there, how do you filter them? Stock screeners seem essential.
Indispensable tools, really. They let you filter the whole market based on criteria you set. Low PE, high ROA, sales growth, whatever.
Narrows the field drastically.
Right. Maybe you screen for ROA over 10%, get 28 names. Tighten it to ROA over 25%, and maybe you're down to just 7. Lets you focus your deep research time where it counts.
But the big warning is you have to understand the ratios you're using.
Absolutely crucial. If you just plug in numbers without knowing what they mean or their limits, you might screen out good companies or fail to adjust for market conditions.
You need context. Does this PE make sense for this industry right now?
Exactly. That contextual intelligence is key. But the great thing is, because fundamental analysis uses public info filings, statements anyone can learn to do analysis comparable to the pros. The data is out there. It's about smart interpretation. 3. Navigating the minefield. Common pitfalls and challenges. Even with the best tools, value investing has its dangers. Maybe the sneakiest is the value trap.
Ah, yes, the siren song of cheapness. Looks good on paper, but
it's actually not cheap at all. These stocks look statistically inexpensive, maybe a big discount to net asset value, NAV, but there's a hidden problem.
What kind of problem?
Often, their balance sheets are weak on liquid working capital,
Yeah.
but loaded with illiquid stuff, old factories, useless land. The issue is, you can't see how the value gap will ever close. How will they actually turn those assets into cash?
It's just dead weight on the books.
Pretty much. And meanwhile, the company might keep losing money, so that margin of safety you thought you had just evaporates. Selling those fixed assets can take forever, hit roadblocks. It's often a dead end.
So it's not just about the discount, it's about the path to realizing that value.
Exactly. Tweedy Brown found that a discount to working capital was a much better indicator than just a discount to total assets, because working capital is more readily usable.
Good tip. Okay, another huge hurdle, us. Our own emotions and
The
biases.
human element.
Yeah.
Massive challenge. Think about market manias, bubbles, prices soaring. Everyone feels like a genius.
False confidence kicks in.
Dangerously so.
Right.
People start taking huge risks, leveraging up, thinking it'll never end. Disaster waiting to happen.
Like Bill Ackman and Valiant. Even smart guys get caught up.
Absolutely. Blinded by nice-looking financials, maybe ignoring fundamental business or ethical risks, got swept up in this story. Then there's Mohnish Pabrai's term, cocaine brain.
Ah, explain that one.
It's how the sheer excitement of potentially making money can hijack your rational brain like a drug. You start ignoring red flags, especially with complex or leveraged companies. Robert Shiller talks about crowd mentality driving bubbles and crashes too. We stop thinking for ourselves.
And Charlie Munger's extra vivid evidence. How does that trip us up?
It's when something really striking, really vivid, like seeing a stock go vertical on TV, hearing stories of quick riches, overrides our rational analysis.
The reptilian brain takes over.
Kind of. You react emotionally, irrationally. Makes it super hard to see that the price is totally detached from reality. Leads to that herd behavior, buying high, selling low. It's hardwired, makes staying disciplined tough when everyone else is freaking out or euphoric.
Guy Spire's story about advisors pushing conventional wisdom is interesting too. Even well-meaning advice can lead you astray.
Yeah, he learned that early on. Following standard advice on fees or redemption terms created problems for his fund later. He realized he needed to build a system, an environment that actively minimized that external noise and influence.
To protect his own rationality.
Exactly. Build a process to keep the cocaine brain and outside pressures from messing up your long-term independent thinking.
What about leverage and shorting? More pitfalls.
Big ones. Leverage, debt. It magnifies returns, sure, but it magnifies losses just as much. As the saying goes, one big margin call can ruin years of good work.
Wipes you out.
It can. Many value investors see heavy leverage as fundamentally incompatible with the patient safety-first approach. It forces your hand.
And a shorting. Betting on a stock falling. Sounds appealing sometimes.
Theoretically, yes, if a company's fundamentally flawed. But practically, it's thorny, as one source put it. Hard to find shares to borrow, fees can be sky high, and the risk of a short squeeze.
Where the price rockets up instead of down.
Exactly. Your losses can be, theoretically, unlimited. Walter Schloss found it uncomfortable. Many think it's more a way for managers to justify high fees than a reliable way to make money for clients. By cash flow, short cash burn sounds neat, but the execution is risky.
Okay, what about investing overseas? Does that diversification always work?
It's often an illusion of diversification.
Yeah.
Yes, you spread assets geographically, but in major crises or rallies, most global markets tend to move together anyway.
Yeah.
True non-correlation is hard to find in developed markets.
And international investing brings its own headaches, right? Regulatory, cultural stuff.
Oh yeah, huge complexities. Some countries, like South Korea historically, didn't even have consolidated financials. Makes analysis tough. Others, like Russia, you worry about government interference overriding shareholder rights. Regulations might be applied inconsistently.
And cultural differences.
Big factor. In some cultures, shareholder interests might genuinely come second to employees or national goals. That's tough for a value investor focused on returns. Many prefer markets with strong rule of law, clear corporate governance where shareholders are clearly prioritized. Predictability matters.
Makes sense. Finally, the big one. Knowing when to sell. The selling dilemma.
One of the hardest parts, even to the best, especially with growth stocks, where estimating that future intrinsic value is really tricky. Easier to buy right than sell right, often.
Monish Pabray has a clear rule, though. Sell when the price exceeds intrinsic value.
That's his guideline, yeah. Simple, valuation-based. The main exception might be holding longer for better tax treatment, like long-term capital gains. Relies on having a good handle on that intrinsic value in the first place.
But Jerome Bose has a different take. He might hold on longer.
He might. He argues some value folks sell too soon, maybe just when it hits book value for a small profit. He thinks if earnings are recovering, the real upside could be much bigger, 100, 200%. Why sell a rare gem too early? Maximize the winners.
So judgment call there. What are other sell signals?
A PE ratio getting way too high is a classic sign the market's gotten frothy. Operationally, seeing big layoffs just to cut costs often signals deeper revenue problems. And maybe the toughest, selling just because it met your original target.
Yeah.
You have to fight the greed, stick to the plan. 4, the mindset of a successful value investor. So we've talked tools, pitfalls, but value investing is really fundamentally a mindset. It starts with cultivating deep patience and a serious discipline.
Like Buffett's baseball analogy, waiting for the fat pitch.
Exactly. Having the discipline to just wait. Don't swing at everything. Wait for the obvious, compelling, low-risk opportunity. It's about being incredibly selective, not constantly active.
Resisting that busy investor urge we talked about. The industry wants you to trade, but value investing demands stillness.
Right. Remember, Emma, the teacher, keep in the journal. Rushing led to mistakes. It's about being deliberate, thoughtful.
And sticking to your criteria, not compromising when something looks tempting but isn't quite right.
That discipline to say no over and over again, that's huge. Waiting for the mark to serve up a real bargain, not chasing maybes.
Okay, patience and discipline. What else? Skepticism and independent thought seem crucial.
Absolutely. You almost need to be a natural bargain hunter type, a bit skeptical, maybe even pessimistic, to really enjoy digging for value.
Richard Pizzina's advice. Forget efficient markets, read Graham, challenge the standard thinking.
Yes. Think for yourself. Do your own homework. Have the courage to go against the crowd, especially when everyone's caught up in some narrative or panic.
Don't let that extra vivid evidence, the screaming headlines, the soaring stock chart, cloud your own analysis of the underlying value.
It's a constant battle against your own biases, against the herd, but essential.
And that skepticism extends to management too.
Definitely. Healthy skepticism is vital. Remember Munger's line, bad industry usually wins out over good management. Focus on the business fundamentals, the industry structure, not just the charismatic CEO.
Okay, so you need to be learning constantly too, right? Expanding your circle of competence. But how do you do that systematically and avoid biases?
Great question. While staying in your circle is smart, it shouldn't be static. As Bill Miller said, you should always be trying to learn new things, understand new industries if you can. The world changes.
So how do you manage that learning and fight bias? Checklists.
Checklists are a powerful tool. Both Pabray and Guy Spire use extensive ones. Spires has like 70 items
Wow, what's the point?
to stop repeating mistakes. To force a systematic, unemotional review of every opportunity. It redirects your attention, makes sure you cover all the bases, challenges your assumptions. It's a way to impose rationality.
Interesting. Now, a big debate, concentration versus diversification. Pabre likes few bets, big bets, infrequent bets.
Yeah, that's the Buffett-Munger school of thought. If you really understand a business and have high conviction, you don't need hundreds of stocks. Quality over quantity.
Buffett's punch card analogy fits here too. Only 20 punches in a lifetime. Makes you think really hard about each one.
Exactly. Or his harem analogy, too many, you don't get to know any well. Focus leads to deeper understanding.
So the argument for concentration is deeper research, higher conviction, maybe even activism.
Right. You know the company's inside out. That builds conviction to hold through tough times. And yes, sometimes big stakes allow you to influence management for the better.
But the risk is higher if one of your few bets goes wrong.
Undeniably. Individual company risk is higher. But the potential return from that deep insight can, proponents argue, outweigh the benefits of spreading yourself too thin. Of course, many find a middle ground, maybe 15, 20 stocks, balancing depth and diversification. It's a personal choice.
Finally, mindset-wise, embracing mistakes and staying grounded seems vital.
Absolutely crucial. Don't let the fear of being wrong paralyze you. Mistakes will happen. It's part of investing.
Like the golfer analogy, learn from the bad shot, focus on the next one.
Exactly. The best opportunities often look risky. If you never make mistakes, you might be playing it too safe, missing out.
And humility ties into this. Confidence is good, arrogance is bad.
For sure. Even the legends have bad runs. Staying humble, reviewing your process, learning from errors keeps you grounded, stops you from thinking you're infallible.
And maybe the most critical part, knowing when you're wrong and cutting losses.
Yes. Michael Steinhardt's rule. If the facts change or contradict your original reason for buying, get out, period. Even if other things still look good. That probabilistic thinking, admitting error quickly, prevents small mistakes from becoming huge disasters.
Wow. We have covered a ton of ground here. A really deep dive into finding undervalued stocks. We've hit the core philosophy margin of safety, thinking like an owner, patience. We've looked at the analytical toolkit, financial statements, ratios, qualitative factors. We explored where to hunt bad news, spin-offs, filings. And maybe most importantly, we've looked at those psychological traps and pitfalls that can derail anyone.
It's a lot to digest, for sure. But remember, value investing isn't a magic formula or a get-rich-quick thing. It's a disciplined, long-term game demanding patience, independent thinking, and the guts to stand apart from the crowd.
So a final thought for our listeners to chew on.
Given everything we've discussed, the emotional markets, our own human biases towards panic and euphoria, here's the question. What personal system, what kind of checklist or process will you put in place? How will you ensure your investment decisions are driven by that cool, dispassionate analysis we've talked about, and not by the emotional whispers or shouts of the crowd?